The $5 billion burn. Alphabet just reported its first ever quarter of negative free cash flow since going public, burning through $5.9 billion in Q2 2026 despite record revenues. This is not a temporary dip or a management oversight. It is the price of a forced structural pivot where capital expenditures hit $45 billion in 90 days. The market is reacting to the record net income, but operators should be looking at the infrastructure load. Alphabet is effectively dismantling its high-margin ad machine to build a low-margin utility, and the negative cash flow suggests the transition is costing more than the efficiency gains can cover. This massive spending on servers and custom silicon confirms that the old search model is no longer enough to support their growth targets. The era of pure software margins at Google is over, replaced by a heavy asset reality of the token economy. The death of the click. The most telling number in the July 2026 earnings call was 22 billion tokens per minute. Sundar Pichai is moving the goalposts from monthly active users to API throughput because the click-through rate is no longer a reliable metric. As AI overviews in the new AI mode absorb the user intent directly on the page, the traditional cost-per-click model is cannibalizing itself. To fix this, Alphabet is shifting towards search as a service, licensing their index to the very AI rivals that are trying to kill them. Think of it like a wholesale strategy. Instead of selling a single ad to a human, they are selling millions of tokens to a bot that needs their data for grounding. It turns Google from a destination into a component. This move captures revenue from competitors, but it also signals that Alphabet has accepted the death of the open web as we knew it. This is a survival play, masquerading as a product expansion. The supply chain revolt. Google's data supply chain is breaking as major publishers like Reddit and USA Today threaten to block their crawlers entirely. These companies are seeing search-driven traffic crater by as much as 40% in a single year, and they are finally realizing that being indexed by Google is now a net negative for their business. This isn't just a PR problem, it's a structural risk to Alphabet's training data. If the biggest sources of real-time information pull their access, Google's LLMs lose their edge. Compounding this is the new EU mandate from last week, which forces Google to share its search data with smaller rivals. Alphabet is getting squeezed from both sides. They are being forced to give their data away to competitors by regulators, while their original sources are cutting them off. This creates a scenario where the cost of acquiring high-quality data will likely spike, putting even more pressure on those already thin cloud margins. The search as a service toll. The pivot from selling ads to selling tokens reveals that Alphabet is positioning itself as the AI toll bridge of the next decade. By aggressively scaling their infrastructure while traditional search traffic declines, they are betting that every AI agent in the world will eventually have to pay them for grounding. This transformation links the record-high CapEx in the first section with the publisher revolt in the third. Google knows it can no longer rely on humans clicking blue links, so it is monetizing the back end of the entire AI industry instead. For investors, the concern isn't revenue growth, which remains strong, but the permanent margin compression that comes with being a utility provider rather than a destination. The real test for Alphabet will be whether they can raise API prices fast enough to offset the billions they are currently burning in hardware. Watch the August regulatory filings for any changes in how they report cloud services revenue. If they start bundling search API fees into cloud, they are trying to hide the true cost of this transition. Subscribe for more